Hello, everyone, and welcome. Thank you for taking the time today to join us for the webinar, Hot Topics for Cross-Border Tax Requirements in AP. This webinar is being sponsored by Tipalti. My name is Anand Misra, and I'm a Senior Director of Portfolio Marketing at Tipalti. Just a few housekeeping reminders before we start. So there is no dial-in for this event, and the audio is through your computer. Please submit your questions via the Q&A section, and we will cover them towards the end. If we are unable to get to your questions today, we ensure that someone from Tipalti will get back to you with a response within a few days. I would also encourage you to look at the Resource Center for more content from Tipalti. Please also complete the course evaluation before exiting your browser. This is required to get your CPE credit. And for optimal viewing, the slides and the screen share views can be adjusted in your console using full screen or minimized windows. So CPE requirements. So if you're interested in receiving one CPE credit for today's webinar, please ensure that you meet the following three criteria. You have to watch today's webinar for at least 50 minutes. You have to complete all three polling questions, which are spread throughout the session, and we will keep them open for about 30 to 45 seconds each to give you enough time to complete them. You will also have to complete the course evaluation, which is referred to as Pass Test in the webinar console. You can access the course evaluation by clicking on the icon in the toolbar at the bottom of the console. And we will keep the console open for about 5 to 10 minutes after the end of the webinar to give you enough time to complete the evaluation. So with that out of the way, let's kick it off. And we have today Laurie Hatten-Boyd, who's a well-known tax expert. Laurie is a principal at KPMG's Washington National Tax Practice. Laurie also heads up KPMG's Tax Information Reporting and Withholding Group. She's a subject matter expert and a thought leader and engages in a wide range of withholding tax advisory services, assisting both financial and non-financial institutions in complying with their U.S. tax information reporting and withholding requirements. Laurie was acknowledged as one of the top 10 prominent people in tax. She was also nominated by the Tax Notes Today as 2011 Person of the Year. Prior to joining KPMG, Laurie was an attorney advisor with the IRS Office of Associate Chief Counsel, where she worked exclusively with Section 1441 withholding regime. Laurie is a frequent speaker on foreign withholding issues and has authored articles appearing in International Tax Review, International Law Journal, and The Tax Lawyer. She's a member of the Washington State Bar Association. Laurie has a JD degree from Gonzaga University and an LLM in tax from Georgetown University Law Center. Welcome, Laurie. And I'm Anand Misra, Senior Director of Portfolio Marketing at Tipalti, where I'm responsible for product, partner, industry, and customer marketing. And prior to Tipalti, I was a Director of Product Marketing with Oracle NetSuite, which is a leading cloud-based ERP solution. And I have over 17 years of experience in product marketing and product management. So with that, I would like to welcome Laurie. The floor is yours. Take it away.
Thanks, Anand. So I'm just going to start here and go over the agenda. First, we're going to just cover Section 1441 in general. This is the withholding code section for cross-border payments, so U.S. source income being paid to non-U.S. persons. Then I'm just going to cover some common misconceptions and some hot topics in this area. And then I'm going to wrap up going over the IRS compliance initiative in this space. The IRS is pretty active right now in 1042 exams, and so we'll just cover what's happening out there in that respect. And we're going to start off first with a polling question. And that question is, when do you collect tax forms from suppliers? Do you do this during onboarding before a payment is processed? Do you try to collect it during onboarding, but sometimes you're not able to and the payment goes out without the tax forms on file? Do you do it at year end or when you're preparing the information returns, the 1099 or the 1042S? Or the last one is you don't regularly collect tax forms? I'll just give you a moment to push that too quickly. Give you a moment to answer. Let's see. Wow, that's impressive. So yeah, you're doing exactly what you're supposed to do. It should be during onboarding. That makes the most sense. You've got the attention of your supplier at that critical point, and they're much more willing to get you what you need before they're set up. Okay, so here we're just going to start going just a general overview of Section 1441. So here at the top we have FDAP payments, and we're going to get into that in detail, but it's fixed or determinable annual and periodical payments. On the left-hand side of this chart, we've got the payment going to a U.S. person. So if they're a non-exempt recipient, so individual, partnership, estate, trust, we've got 1099 reporting. And if you don't have the TIN in the manner required, there would be a requirement to impose 24% backup withholding. I said TIN in the manner required because depending on the payment, you don't necessarily have to have a certified TIN, which means on a W-9, which though that's the easiest. And I would also note there has been some recent legislative proposals. In fact, the Biden Green Book for the administration's wish list for tax had a provision in there that would require a W-9 in all cases, not just for interest, dividends, and proceeds of securities, which is what it's limited to right now. But anyways, if you don't have that TIN as required, then you would impose the backup withholding. At the end of the year, you issue the Form 1099, the IRS gets a copy, the recipient gets a copy, and that's how the IRS is able to match up the income reported on the 1099 with the payee's tax return, and of course they get the nasty gram when it doesn't match up. On the right-hand side, this is what we're going to focus on today, and this is those same FDAP payments going to non-U.S. persons. Here, unlike the U.S. person, where there's going to be reporting regardless of whether the source of the income is U.S. or non-U.S., here we're only focused on U.S. source payments made to non-U.S. persons. It's subject to withholding. The starting point is a statutory 30% withholding tax gross basis. And then that can be reduced under an income tax treaty, or there's some certain code exceptions. The documentation is always going to drive whether you as the withholding agent is able to reduce that 30% reporting. I'm sorry, withholding. And here we have Form 1042-S reporting. This is just the non-U.S. equivalent of a 1099. The IRS gets a copy and the recipient gets a copy, just like the 1099, and the IRS then will share that information with any country with which it has an income tax treaty that has an automatic exchange of information provision. If there isn't an automatic exchange provision, the IRS maintains that data, and then the country that has the tax treaty can request it, and there's provisions for competent authorities to do that. So here, again, our starting point is U.S. source income paid to non-U.S. persons. The character and source of the payment is the responsibility of the withholding agent. So you've got to make that determination before you make the payment, because that, of course, is going to drive how you're going to treat this payment, whether it's subject to withholding because it's U.S. source, and then whether you're able to reduce that amount because you've got tax documentation on file that would support a lower rate. The year-end reporting here, there's an annual Form 1042. That is the actual tax return where you report the tax liability and the withholding that you imposed and deposited. And then there's the Form 1042-S. We talked about that. That's the information return. Both of these are due on March 15th of the year following the calendar year of the payment. You can get an automatic 6-month extension for the 1042, the tax return, by filing a Form 7004. You can get a 30-day automatic extension for the IRS copy of the 1042-S by filing a Form 8809. And then the recipient copy, people need to remember, it's a separate process. I'm not sure why. But you just draft a letter to Martinsburg. There's a fax number in the instructions to the Form 1042-S, and you just request the 30-day extension for that. So it's important that you make sure that you take care of that two-prong approach to get the 30-day extension for both.
Laurie, if I can quickly interrupt for a second, can we go back to the polling question number 1, because a lot of people missed it due to some technical glitch, I believe.
Oh, sure.
If we can just go back. Appreciate that.
Oh, now I probably told everybody good job, and maybe it wasn't. Okay, here's the question. So again, it's when do you collect tax forms? During onboarding, when you're setting up that supplier in your system, The second one is you try to collect them during that onboarding, but you aren't always able to before you're required to make a payment at year end before you file the information returns, or you don't regularly collect tax forms. I see at the bottom now, so I'll just wait till.
Let's see if they really did the right thing, Laurie.
Okay, now we'll see. So yes, most people are still doing the right thing, and I will add a caveat. I am kidding with that. If you're not making payments of U.S. source income, or you're only acquiring goods, and we're about to go into what is FDAP payment. If you're only purchasing goods, you actually wouldn't need a tax form because there's just no withholding, no reporting, regardless of the status of the payee. Okay, so now I'll move back. Okay, so what is this income we're talking about, these FDAP payments? As I had said, it's fixed or determinable annual or periodical income. It's really all income other than the gain from the sale of property or market discount or option premiums, which you guys aren't going to be dealing with. So it's really going to include anything: compensation, if they're performing personal services in the U.S., rents, royalties, director's fees, interest on accounts payable, prizes, awards, things like that. I said that goods are excluded, or gains from the sale of property. There is one caveat I need to add to that. If it is a sale of an IP right and the sales price is contingent on future use, that's actually going to be treated as a royalty as opposed to a sale of the IP right. And so that would be subject to withholding and reporting. Again, the source of the payment is the responsibility of the withholding agent, and the regulations have mandatory presumptions that you must treat the payment as U.S. source if you can't reasonably determine the source. And I have an example here where there's going to be, it's a service agreement, and there's going to be services performed inside and outside the U.S., but that's not known, what that allocation at the time. Here we have an upfront flat fee that's due. The presumption rules and the regulations would require the withholding agent to treat the entire amount as U.S. source because you can't determine at the time of payment what that source is. And documentation is really the cornerstone to Section 1441 withholding. So the documentation, the W-8 or the W-9 that you would obtain is going to help you determine, is the person U.S., they give you a W-9, or are they non-U.S., W-8? Are they the payee or the beneficial owner? Now what that means is the beneficial owner is the one that would take the income into account under our code section 61. So they actually own the income, as opposed to a payee, which is someone that's receiving it on behalf of the beneficial owner. So it might be an intermediary, a nominee, an agent, or a partnership that's receiving it on behalf of a partner. It'll tell you the classification of the payee or beneficial owner. Are they an individual, a corporation, a partnership? And it'll also enable you to determine whether you can reduce that statutory 30% of withholding. So here where you're making U.S. source payments, it's imperative that you have the documentation on file before you make the payment. Otherwise, there's also mandatory presumption rules in the regulations that generally are designed to ensure that the maximum amount of withholding is going to be imposed. We're going to go to polling question number 2. Hopefully this will work this time. Which tax form do most of your suppliers submit? And that would be a W-9, a W-8BEN, a W-8BEN-E, or none. You're located outside and you just don't need these tax forms. see some comments that it's not working, but it looks like it's almost got 80%, so maybe it's just slow. Okay, move on. So it looks like W-9 is the prevalent form. So it looks like most of your payees are U.S. persons. So I'm just going to go over these various types of the tax forms. So of course the W-9 is for U.S. persons. So these forms listed here are when you're making payments to non-U.S. persons. So the form W-8BEN, BEN stands for beneficial owner, and this is for an individual. So there used to be a W-8BEN that was for any beneficial owner, regardless of status, whether they were an entity or whether they were an individual. And when FATCA came to be, there's like 42 some odd FATCA statuses, and that W-8BEN morphed from 1 page to 8 pages. So the IRS wanted to keep it as simple as possible for individuals, so they separated out these forms. So the W-8BEN now is for individuals only. They are using it to claim that, yes, I'm the beneficial owner, I'm a non-U.S. person, and then there's a treaty section if they're entitled to a treaty reduction. Then the W-8BEN-E, again, beneficial owner and entity, that E is for entity. So again, they're certifying I am the beneficial owner, I'm not U.S., and again, they can claim treaty benefits if they're so entitled. The W-8ECI stands for effectively connected income. So it's a non-U.S. person, so certifying I'm not U.S., I'm the beneficial owner, and this income is effectively connected with a U.S. trade or business that I have. In that case, there's no withholding, and because this person files a U.S. tax return, because that income is associated with their U.S. trade or business, and they would be taxed just like you and I. They're not taxed on a gross basis. They get the deductions and are taxed at the graduated rates. Then the form W-8EXP, I wouldn't expect you to be seeing these in the normal accounts payable environment. These are when a foreign government is claiming an exemption on certain investment income under Section 892, or the equivalent of a 501c3 that's non-U.S. that would be claiming that code exception. Then the W-8IMY, this is when a person is receiving the payment on behalf of someone else, so that difference between the payee and the beneficial owner. So this would be completed by an intermediary or a nominee or agent or a partnership or other flow-through entities that's receiving the payment on behalf of someone else. And they would be passing up that documentation for whomever they're receiving the payment for, along with a withholding statement that, among other things, would allocate the payment to each underlying owner. So you, as a withholding agent, would withhold and report directly to the underlying owners based on the documentation that you have. And then finally, we have this form 8233. This is the oddball form. This is when it's for an individual that's performing services for you in the United States, and they're claiming a treaty benefit. I call it the oddball form because the other forms are generally good for the year signed and the next 3 full calendar years. You, as the withholding agent, just keep them in your files for if and when you're under exam, you would show them to the IRS. This form, you actually validate it and then send a copy to the IRS, wait 10 days. If you don't hear back within 10 days, you can make the payment with the treaty claim. I used to say the IRS wasn't looking at these because I had never seen them come back. I am seeing them come back now and saying this is not a valid form. Unfortunately, these responses are coming long after that 10-day period. So you, as the withholding agent, as long as you wait the 10 days before you make the payment, even if you receive that letter later saying that form didn't support the treaty claim, you're still okay because they're coming like a year and a half after the time they're being sent in. So you, as long as you're within the 10 days. And this form is also the oddball because you have to get a new one every single year. So if you've got a multiple year engagement with this individual, they're going to have to give you a new 8233 for every calendar year that you're making payments to them. Okay, the IRS recently released updated versions of these W-8s. The revision date is October 2021. Most of the changes relate to new certifications that are needed for Section 1446F withholding, and that's a new 10% withholding when a non-U.S. person sells a share or an interest in a partnership that has U.S. source effectively connected income. So not going to affect you, I wouldn't think, but I will highlight what has changed on the form that would, on these forms that would affect accounts payable. The critical thing is these new forms, you must start using them on or before May 1st of next year. So you can continue to accept the old version of the forms, the 2017 versions, up until April 30th, 2022. But beginning May 1st, you have to start using these new October 2021 versions. And the IRS on exam is very particular about that the correct version of the form is being used. So here I'm just limiting, again, there was a lot of changes on these forms, but this is really what's critical to an accounts payable department. So on the W-8BEN, they've eliminated the capacity to sign box or line. That was a line when somebody else other than the individual was signing the form, so somebody was signing under a power of attorney or maybe a parent on behalf of a minor child. They've replaced this with a checkbox. The instructions say that the checkbox should only be checked when somebody other than the individual that's the beneficial owner is signing the form. I presume that it would be an inconsequential error if the individual that's filling out the form checks that box, because we anticipate that they probably will, because it's just right there before the signature, and I doubt they're going to go to the instructions and read that. But so I wouldn't get concerned if you're seeing that checked across the board. On the W-8BEN-E, they've added a no LOB in the treaty section. LOB is limitation on benefits. It's a provision, an article in the treaty that is really there to prevent treaty shopping, so that somebody can't just set up an entity in a treaty country and claim the treaty benefits when they really don't have any ties to the country or pay income tax in the country. And under the prior version of the form, a few of the very, very old treaties don't have a limitation on benefits article. As those older treaties get renegotiated, at some day in the future, all treaties will have this, but currently there are some that don't. And if you were resident in one of those countries, the instructions to the prior version of the form said you checked the other box and put NA. Well, everybody was missing that because, again, nobody's reading those instructions like that in detail. So now they actually added a checkbox that says no LOP. So hopefully that'll eliminate some of these mistakes. And then they also, there's the checkbox capacity to sign. So this the W-8BEN is for an entity. And years ago, they moved the capacity line where they wanted an officer, some kind of officer designation as the capacity. They changed that to a checkbox that they have the capacity to sign. It was underneath the signature line. So again, just based on industry comments, the IRS moved it up above the signature line, hoping that it wouldn't get missed, because a lot of people inadvertently missed that, which made the form invalid. For the W-8 IMY, we have new checkboxes for an alternative withholding statement. I don't know if a lot of you obtain withholding statements or have, payees that are partnerships or agents or nominees, but the withholding statement requirements and the regulations require like 20 different fields in the withholding statement. And almost all of that information you can gather from the forms that are being passed up. I don't think I've ever seen a withholding statement that actually was valid or pristine per the regulation requirements. So they revised the regulations to say if the person providing the withholding statement with the IMY certifies that the information on the forms that they're passing up does not conflict with any of their file information, that you could use this alternative withholding statement, and all you needed was the name of the person and the allocation of the income. Well, of course, people were not making the certifications on the withholding statement as they needed to be. So they actually put a checkbox for the partnerships and the non-withholding foreign trusts, so a grantor trust or a simple trust, where they actually check a box that there's no conflicting information, and so that they could use the alternative withholding statement. So again, just trying to eliminate some of the routine errors that were happening. For the W-8 ECI, for the U.S. address, they updated it to make clear that the U.S. address could not be a P.O. box. And again, the same as the BEN-E, they moved the capacity to sign checkbox up above the signature line, again, in hopes. All of this was really based on industry comments to the IRS in hopes of not having those routine errors that were happening on those forms. So again, I had said statutory 30% withholding at the time of the payment unless you have documentation to support a reduced amount. and I had talked about presumption rules if the documentation isn't on file. And you have to follow the presumption rules. They're mandatory unless, based on your actual knowledge, you would withhold a higher amount or report when you wouldn't otherwise. When these presumption rules were originally drafted, it was back in 1998, and the backup withholding rate at that time was 31%. So we didn't have these situations where your actual knowledge would come into play because it was always the highest rate of withholding based on the presumption rules. But now that, once the backup withholding rate went to 28% and then now 24%, we are seeing situations where your actual knowledge may trump the presumption rule and the regulations, in which case you would use your actual knowledge and withhold at the higher rate. So for an individual, it's generally going to be a presumption that they're a U.S. non-exempt recipient, and 24% backup withholding would be required. And here's a situation where that actual knowledge may come into play. So let's say they're non-U.S. and they're an individual, and if you were paying non-U.S. source income, you're paying income that wouldn't be subject to withholding for a non-U.S. person, so non-U.S. source, sorry. Your presumption, if you used your actual knowledge, it's at 0 versus 24% backup withholding. But if it was 30%, because it's U.S. source income, if I followed the presumption rules, I would only be withholding 24%. So that's a situation. If I'm paying that person U.S. source and non-U.S. source income, I would use the presumption rule and impose 24% backup withholding on the non-U.S. source income, because that would have otherwise been 0 for a non-U.S. person. And I would use my actual knowledge that I know they're a non-U.S. person and withhold 30% on the U.S. source income. So it can get very complicated. So point being, just get the tax documentation and you don't have to be in these very complex rules. For entities, the presumption is going to be based on indicia that you have. If you have non-U.S. indicia, and for accounts payable, that would be you've got a non-U.S. telephone number, or the address that you would mail communications to them would be a non-U.S. address, then you would presume them to be non-U.S. If there's no foreign non-U.S. indicia, then you would treat them as U.S. Then I'm just going to quickly go over some of the misconceptions in this area. First we're going to do a polling question. So how do you calculate the withholdings? Are you doing it manually on a spreadsheet? Do you have a homegrown tool that you're using? Do you have a complete AP automated tool that's calculating the withholding? Or you don't need to have that because the payments you're making aren't subject to withholding? And I'll just give you guys some time to do that. Hopefully this one will go smoother. So it looks like it's pretty spread. So I'm assuming if you're doing it manually, I'm hoping that you have a small number of payments. Otherwise, that could be a very onerous task. So it looks like it's pretty spread there. But although a high percentage of people that aren't making payments that are subject to withholding. So I assume that's just the purchase of inventory or supplies. So just going over first the W-9. So some of the misconceptions with the W-9 is that the entity status must always be completed. The regulations for a valid W-9 say there must be a name, a TIN, a signature, and a date. So anything else on that form would not be required. Now that said, if they're not showing the payee code as an exempt recipient and their name doesn't clearly designate them as a corporation, you would have to do 1099 reporting that you may not otherwise have to do had they completed the form in its entirety. And also, if they do complete a field, even though it wasn't required, you need to make sure that it's consistent. And I just gave some examples there. The second one, and this is coming up a lot lately, I'm not sure why, but there's a misconception that the address on a W-9 has to be a U.S. address. It absolutely does not. It doesn't matter. Unlike a W-8 where we've got an inconsistency if they provide a U.S. address, here if they provide a U.S. or a non-U.S. address, either is perfectly acceptable because they're certifying to be a U.S. person. And the last one, and this gets confusing too, is that there's a misconception that the withholding agent or the payor that's receiving that form, if it's not dated, that they can date stamp it. And that's not true. Again, as I just said, dating it is a regulation requirement. So the instructions to the W-8 requester, for the requesters, says that the withholding agent, if the form isn't dated, they can date stamp it on the date they receive. A W-9 does not have that same provision. So if it's not dated, it's not a valid W-9. And then on the W-8 side, the first one is that for a W-8BEN, that the line 2, the country of formation, is always required or it's an error. I wouldn't think this comes up a lot in accounts payable, but if it did, if it's a trust or if it's an international organization, they could actually have U.S. and it would still be fine. And that's because for a trust to be a foreign trust, it's a two-pronged test. It's that a non-U.S. person controls it and a non-U.S. court has jurisdiction. And if it's not both of those, then it would be a U.S. trust. But you could have a U.S. address and still be a foreign trust because of that court and control test has been met. The second one, and this is important to you, is that the FATCA status is always required on a W-8BEN. Absolutely not. If you're making a payment that's not subject to FATCA, so if it's not a withholdable payment, which is really a FDAT payment that's financial in nature, so interest, dividends, bank fees, things like that. So for your normal accounts payable, those are going to be excluded non-financial payments. So you do not need a FATCA status on that form. And in fact, the regulations provide that you can create a substitute form and remove all of the FATCA statuses, and it's back to just barely over one page for that W-8BEN for accounts payable type payments. And in fact, that's the example in the regulations that they use is for these routine accounts payable where you don't need the FATCA status. The next misconception is that you could never have a P.O. box. And you would think that because it says right on the form, cannot have a P.O. box. But there is a notice, 2001-4, that says that a withholding agent can accept a P.O. box as a permanent residence address as long as it doesn't know or have reason to know that a permanent address exists or know or have reason to know that the person's a U.S. person. That notice was drafted because certain countries came in and talked to Treasury and the IRS and said, we don't have physical street addresses. And then also places like rural routes in Canada where there aren't physical addresses. So that's addressing that kind of situation. But obviously if it has a P.O. box and it's Paris, France, there's street addresses in Paris, France, so that wouldn't be okay. So you have to kind of use your logic there to see if it makes sense that it might be a place where there would not be physical street addresses. And then also an care of address or a P.O. box can always be used if it's an entity and that's the address of their registered agent. And just moving on, that a U.S. address must always be cured. In general, yes, if you have a U.S. address, permanent residence or mailing address, the general rule would be that is conflicting with their certification of non-U.S. status, so you would need some curative documentation. But if it's a W-8 ECI, again, they're claiming that the income is associated with a U.S. trade or business and the form actually requires a U.S. address on that form, or a W-8 IMY. That's when somebody's an intermediary or a flow-through entity, and it doesn't matter if there's any U.S. indicia. When you look at the due diligence rules in the 1441 regulations, it only applies to beneficial owner withholding certificates. Because an IMY, they're claiming, in fact, they are not the beneficial owner. We don't have to worry about those same problems with addresses. And then the last one is that an affidavit can cure everything. So the regulations allow you to get a tax form after the fact if it has a retroactive affidavit. And that's where the person signs and dates the fact that the information that is provided on that form was true and correct back at the time that you made the payment to them. The regulations were expanded recently to put a little bit more guidance on that. So if you receive the tax form within 30 days of the payment, you don't need the retroactive form. If it's more than 30 days up to 1 year, then you need the tax form and the retroactive affidavit. And if they're providing the form more than 1 year after you made the payment to them, you're going to need the retroactive affidavit plus some additional documentary evidence to support the claims made. So, for example, if it's a treaty claim, you might want to get a residency certificate or articles of incorporation, some type of documentary evidence like that that is going to support the claims that they made. And we just talked about this, and I'm going to hone in on it a little bit more because the IRS really looks at this on exam, and it's the wrong version of the form is used. So I mentioned that we now have this new October 2021 revision date. The instructions to the requester say you must use a new form. It's the later of 6 months after the revision date or the end of the calendar year that the revised form is issued. So here the later of is going to be the 6 months. So again, the 6 months will end April 30th of 2022. So you have to start using that October 2021 form May 1st on. It's not the date on the form that's relevant, it's the date it's presented to you. So if it's presented to you before that date, because a lot of people will fill out a bunch of forms and they just have them sitting there. Probably doesn't happen as much in accounts payable. It happens a lot with like hedge funds and things like that where they're passing out these forms quite frequently. But if they do have that where they're filling out a bunch and then just passing them out when they're requested, it's the date that it's presented to you is the date that you're looking at as to whether you can accept that form. And then I just had an example here, and I won't go into the details, but it's when you're receiving underlying documentation with a W-8 IMY, as long as it's possible that that form could have been presented to the intermediary within the proper time period, then it's fine. So in other words, when you're looking at the date presented, for you, it's the W-8 IMY that you're looking at the appropriate date. For the underlying documentation, it would have been the date presented to their agent or intermediary. So it actually might not be the same, but as long as it's plausible, you may accept it. And then I'm just going to wrap up here with what's going on with 1042 exams right now. The IRS has been very active in this space. They had said for, oh my gosh, over a decade that they were starting an enforcement initiative in this space. And, you know, we were gearing up and telling everyone. And after a while when nothing happened, I felt like Chicken Little out there telling everybody the sky is falling when it's not. But they actually are very active now. They've got territories set up around the country. They're all supported by a main group in New York that has traditionally done the exams for financial institutions, which, you know, prior to them getting more active in this space, that's really the only people that were audited. But now they are very focused on the non-financials. Again, they've got territories across the country. And I'll just kind of go through what it is that they're looking for and how you best can be prepared to deal with an exam. So the starting point would be the IRM. They've updated the IRM, and they have a specific IRM, and for those that you don't know, that's the Internal Revenue Manual, so that's like the rule book for IRS examiners. They have a specific IRM for 1042 exams for non-financial entities. And if you take the time to read through that, it's casebook. It's exactly how the IRS is implementing these exams. So you will know exactly what's going to happen if you read through that. They've identified here the industries that they're looking at, and it seems pretty in line with what they're doing, the professional services, the high tech, the entertainment, publishing, pharmaceutical. That's really, we are seeing a high number of exams there. And even with the COVID shutdowns, they have actually managed to be able to do this all remotely. So this has not slowed them down as we've all been at home. So the focus now, so let me take a step back. Historically, when they did these exams, they were documentation driven, you know, where the I's dotted and the T's crossed on the form. Don't get me wrong, they still care about those forms a great deal, but they're really looking beyond that. They're looking at the due diligence. Do you have any information in your file that conflicts with the claims made? So meaning, is there a U.S. address, or is there an address outside the treaty country if they're claiming treaty benefits? So they're really looking at that, and they're really looking at the substance of the transaction. You know, they're really digging into the contracts. Was it a royalty? Was it a sale of IP right? Was it a lease? Was it a service? I mean, they're really making those determinations, whereas before we didn't really see that. And then on the Forms 1042S, we're seeing them impose a lot more penalties for using incorrect codes. So historically, as long as you had the income and the tax amount right on that form, they just turned their heads, and we were seeing codes all over the place. But they really are looking at these codes, and they are imposing penalties. And I don't know if you are aware of it, but the IRS had teamed up with a software provider called Fairfax and created a 1042 data integrity tool. And they just opened it up for everybody to use. It's on the IRS website, and you can access it through there. And you can upload your 1042S information prior to submitting it, and it will tell you if there's certain errors or cautions. It's a great tool. I would recommend anybody that's got 1042S reporting to use it. The IRS does not keep the data. They will not know which. They maintain, aggregate data, not per withholding agent. So they will not know if you use it or not. And in fact, they in the guidance it says that they will use this when considering whether they're going to impose penalties. So you as the withholding agent, if you use this tool, you need to keep the record of it to show them, because they're not going to have record of it. And that is done by design because they want to encourage the use, and they're concerned that people wouldn't use it if they think that they're monitoring them. So just a few things to know. This always seems patently unfair to me, but when they're looking at sampling, if you have a lot of cross-border payments, they're actually going to pull a sample as opposed to reviewing everything. They will exclude every payment that was subjected to 30% withholding, which, again, doesn't seem fair to me. If you're going to have a valid sample, it seems like everything should be in there, but this is just the policy they've adopted. If you've got high dollar, they're going to exclude low dollar payments. So generally, we'll see them pick $1,000 and under and not have that in there. They will allow you to cure. I had talked about those retroactive forms during the exam if they find invalid documentation, but you have a very limited time. You'll have like 60 days, and oftentimes you can't even get a hold of the right person at the entity that you need the new form from within that time period. But to the extent you can get the tax documentation within the time period that they'll give you, they will not extrapolate that error. So let me take a step back and explain that. So normally what they do is they will come up with the liability for the sample, and then they will extrapolate that liability across the population. Before, they would always allow you to cure, but what they would do was extrapolate the liability in the sample across the population and then subtract out the amounts for the cure documentation. Now they will actually extrapolate the cure, which is a great thing. So meaning they'll have the liability for the sample less the amounts for the cured documentation, and then that net amount is what will be extrapolated as a liability. So that actually is a nice thing from them. But again, you don't have a lot of time to cure. So just going through, what should you do now? So they're going to ask to see your policies and procedures. So you want to go look at those, dust those off, and make sure they're current. That's going to be one of the things that drives the exam. And that opening meeting, if you show them pristine policies and procedures that are up to date, and you discuss your processes, and it sounds like you really know what you're doing, that's going to be taken into consideration with how deep of a dive they're going to do here. They're not going to spend a lot of time if they don't think that there's money to be had for them. But if they come in and you've got 10-year-old policies and procedures, and nobody really seems to know how or who is determining the character and source of the payments, things like that, it all makes a difference. Make sure that you're. One thing to tell you. They used to their starting point used to be the 1042S's that you filed. Not anymore, because they want to know what you missed. And they're doing their research. They're on the internet. They are researching your company. When they come into that opening meeting, they've got a lot of questions about certain lines of businesses that you may have, certain products that you may have. They really know what's out there as far as your business before they talk with you, and they'll be asking about certain payments that they're not seeing, and it may just be that they're non-U.S. source, but make sure that you know what each of your business lines are doing and the types of payments that you're making to make sure that everything's being captured. They're also looking very closely at related party payments. And I think there you'll want to look to the work papers for the Schedule M in the 5471. They're looking at the 5471 and Schedule M in particular. And a lot of that will be non-U.S. source income, but they will be asking questions about that. And so you want to make sure you're looking at those work papers to make sure that you've captured everything. And then just the reconciliations. They want the 1042 amounts to reconcile to the 1042S amounts, which sounds like common sense, but it can be a very hard undertaking. I would suggest that you probably try to do that on a quarterly basis, so you're not, at least though, at a minimum annually. You don't want to try to be doing that, 3 years after the fact when they're, examining a year prior. It's very difficult. And then just managing the audit. Ask for draft IDRs. Make sure you know what they're asking you before they issue it in final form. They are very good about giving you additional time if you ask for it up front. So understanding their ask to know how much time it's going to take you is important. Once they issue the IDR, it's very difficult. It's not that they're being difficult. It's difficult for them to get their management to sign off on additional time. They can do it up front before they issue that in final form, but that's why it's important to have those conversations up front so that you know exactly how long it's going to take you or have a good idea so that you can ask for additional time. If they say 60 days and it's going to take you 6 months, that's okay. Just explain why and ask for the additional time, and they've been very reasonable. If it's going to be a sample, work with them on the sample. Have a statistician work with them. Don't just accept whatever sample they came up with, because there's all sorts of different ways to handle that. And then the last thing here is just be prepared. Know what you're going into. I always say conduct an annual health check. Pretend like you're the IRS and pick some payments and go through and look at the tax documentation. Make sure that the withholding that you imposed is supported by the tax documentation, and then out to the reporting. Make sure that you report it correctly, that you use the correct codes. Because if you didn't, all of this can be fixed. We have this concept again of the retroactive form. You can amend the forms and correct coding problems. So I think it's important to know where you stand, and I think that's the best way to do it, is just to have that built-in process where you're continually monitoring yourself. And then just the final point I'm going to make is, what do you do if you've done all this? You've remediated what you can, you've identified errors. You can, again, amend the reporting, but what if it's just you can't fix the tax documentation? You gave a zero rate under a treaty, and they live in Brazil, which is not a treaty country, and there's nothing you do. If you've got a lot of that, you could consider a voluntary disclosure. The IRS has a group set up now within the foreign payments practice. They're physically located in Chicago. Very reasonable group. It's a very simple process. And because you're coming in voluntarily, you're going to get the penalties taken care of. So something to consider, if you find yourself in that situation and you've got a liability and there's just nothing you can do about it. And with that, I am going to turn it over back to Ahmad.
Thank you, Laurie, for the highly compelling and relevant content, especially given the time of the year. I know that it was a lot to take in for the attendees. The good news is that we are recording this webinar, and it will be available to the viewers later as well. So in the next section, I will provide some highlights about the Tipalti solution itself. So since this event is specific to tax, I will begin with our tax module, which is, of course, KPMG approved. And Tipalti solves the complex and highly manual process of basically collecting the tax information through a digital capture directly during the supplier onboarding, which essentially does two things. First, it ensures that the tax information is collected, and second, it is validated before a payment is processed. So Tipalti's tax solution for the U.S. payers basically simplifies the process and helps businesses comply with IRS tax provisions. So you can require all payees to fill out tax forms or provide their VAT or local tax ID as a part of self-registration on the Tipalti portal. And our guided tax form wizard helps suppliers of U.S. payers select the correct tax form based on their country and business structure itself. So, and once the tax form itself is selected, Tipalti then digitizes these tax forms and applies over 1,000 plus rules, including TIN validation, to ensure that proper data has been provided. And we also support the W-9 and the complex W-8 series of forms that Laurie was just talking about. And what we do also is at the year end, we generate the 1099 and 1042S tax prep reports and calculate any necessary withholdings. And we've also added the capability recently for automated 1099 tax filing, leveraging our integration with our partner Zenwork. And our customers can start taking advantage of the new capabilities immediately. And of course, for non-U.S. payers, Tipalti collects and validates local and VAT tax IDs in about 50 countries per se. So this is the Tipalti wheel, which basically highlights our philosophy that if you put a robust system in place now, you will not outgrow it as you grow. And what I'll do in the interest of time is I will provide a quick overview without going into too much details so that we can move on to the Q&A section. So we provide an end-to-end solution to manage the entire payables operations that you see from the top, from self-service supplier management to an onboarding, with, of course, like I mentioned earlier, a KPMG certified tax engine. We have procurement management solution with purchase acquisitions and PO creation as well. We also have an invoice management solution with OCR, machine learning, and managed services. And you can also do 2- and 3-way PO matching if you've got PO-backed invoices. We are a licensed money transmitter and a regulated financial institution, and we pay across 196 countries in 120 currencies with 6 different payment methods, and also perform sanction screening to ensure that businesses are not paying anybody who's on a government watch list somewhere. And we also provide a built-in FX solution, which is easy to use and fully automated with a self-service capability to convert currencies for entities with live and transparent exchange rates. And of course, we integrate with any ERP for reconciliation and reporting purposes as well, which basically ensures a faster financial close. The one last capability that I want to highlight is NetNow. You see under the service foundations below, which is our built-in early payment solution. And you can also manage unlimited number of entities within the same instance of Tipalti. So this is another way of looking at Tipalti. So we have over 1,500 customers, some of which that you see on your screen. We take pride in serving our customers and are proud to have a 98% customer satisfaction rate and a 98% customer retention rate as well, which is by far the best in the industry. And more than $27 billion is transacted annually through our system for well over 4 million payees around the world. And this amount is growing every year. It's actually doubling every year, I would say. And our name Tipalti means we took care of it in Hebrew, which implies that let us take care of your global payables operations, which then allows you to free your resources to focus on more value-added activities. So again, before we move to the Q&A section, just a quick reminder on the CPA requirements. If you're interested again in receiving the CPA credit for today's webinar, please ensure that you meet the criteria. You've already watched today's webinar for about 15 minutes. Hopefully everybody had a chance to complete all the 3 polling questions. You also have to complete the course evaluation, which is referred to as the PASS test in the webinar console. And you can access the course evaluation again on the icon in the toolbar at the bottom of the webinar console. And as I mentioned earlier in the beginning, we will keep it open for about 5 to 10 minutes at the end to give you enough time to complete the evaluation. With that, we will open it up for Q&A. There are quite a few questions coming along. Let's see how many we can get in the next 5 to 6 minutes. And Laurie, the first question that I have is, if we have a foreign contractor working on a project in this country, which is the U.S., and we bill our U.S. client for his work, do we still need to prepare 1042?
So let's do that one more time. Read that. I want to make sure I'm understanding.
Sure.
If they contracted with a foreign person, but there's somebody in the U.S. that's performing the service, is that correct?
Correct. And they're billing this U.S. client here.
Yeah, if you've contracted with a foreign person, It would be FDAP payment if they're performing the services in the U.S. It would be to the foreign person, even if the payment is going elsewhere. The only thing that would change it, so if they subcontracted, for example, somebody in the U.S., that is now U.S. source services being paid to a foreign person. People get confused with that oftentimes. The only thing that would change this, and I would suggest you do this if you have that kind of situation, so either they subcontract or they have a U.S. sub that they use, you want to have a tri-party agreement. If you have a tri-party agreement, then you can have the separate payment flow and invoicing from the U.S. person that's doing the U.S. work, and now we have payment to a U.S. person. But if you're only contracting with the non-U.S. person and they're subcontracting or however they're dealing with it, and you're actually getting invoice from the U.S. person, that doesn't matter. You have a contract with a foreign person, and you have a legal obligation to make a payment to that person, even if they direct payment elsewhere. That would be, the IRS would look at that as a payment to a foreign person and a constructive payment from them over. So, yeah, you want to make sure if you're going to have that scenario that you actually have a tri-party agreement where all three parties are signing it, and then you don't have to treat that U.S. source piece of it as paid to a foreign person.
So almost on similar lines, Laurie, but a different flavored question. So do you need to withhold tax for offshore individual or a freelancer who accepts a project from the U.S. and then completes the job at their residential country?
Yes, so in that case, and I'm glad you brought that up because I actually didn't mention this when I was going through this. So I had mentioned that the character and source is the responsibility of the withholding agent. When it's non-U.S. source services, the IRS wants to see that in a contract, the statement of work, on the face of the invoice, or some other certification from that non-U.S. person, and an email is even fine. So in this case, where that person is performing everything outside the U.S., as long as you get a certification from them that all services are performed outside the U.S., then it's non-U.S. source services to a non-U.S. person, so no, you would not have to withhold or report. But you got to make sure that you've got that certification that all services were outside the U.S., or the IRS is going to come in and apply that presumption rule and say it's all U.S. source.
Absolutely. So this person is asking a question, Laurie, that the company that I work for is in the U.S., and it buys goods for resale in a foreign country. So the withholding tax is not applicable.
Right.
I think it's a question, right? Yeah.
Yeah, if it's a sale of goods, so regardless of what they're going to do with it afterwards, and even if selling outside the U.S., it's just not in scope because that's going to be gains from the sale of property, which is not FDAP income. Now, let's say there was some associated services. So it's a hardware that there's going to be installation. So we have services. So again, as long as everything's outside the U.S. and the installation is at somebody's location outside the U.S., you just want to make sure you've got the certification that the tangential services were performed outside the U.S., and then you would have no withholding, no reporting.
The next question, Laurie, is that do you report all payments made to entity who provides a W-8 ECI?
Yes, so if they give you a W-8 ECI and the income that you're paying them is listed on that W-8 ECI, it's going to be covered by that form. So even if you're paying non-U.S. source income, you're going to report it on a 1042 as ECI income. So you just want to make sure that to make sure the form's covering the income, because there's a line there where they're going to say what income is covered. So if the income you're paying there is on that form, then yes, you would be reporting all of it. And I'll note one thing, that October 2021 updated form, the line for them to write in what type of income is covered has gotten very small because they needed other fields. So the instructions say to go ahead and attach a statement if you can't fit it in there. So I would anticipate you guys are going to be getting a lot of statements if you're getting W-8 ECIs because that line is like 1 inch long now.
I think we're almost at the top of that, but I'll try and squeeze in one more, Laurie.
Okay.
This is about different versions, the newer versions of the forms that are coming out. So do we need to request updated versions of W-8BEN and W-8BEN-E for our vendors, or they can consider an old version that the vendor has already provided?
Great question. The forms you have now are valid until their normal expiry date. So you don't have to go resolicit new forms that are currently valid just because we have a new version. But once they expire and you have to get a new form, you're going to have to use the new version. So again, anything that you've got on file now will remain valid for its normal shelf life, for lack of a better word. So again, that year signed plus 3 full calendar years. And it's not until the end of that period that you have to get the updated version.
So one last question, Laurie, and this is, hopefully it stumps you, is a lot of the times the IRS fax number doesn't even work. So what are we suggested to do when we cannot get the form to them?
I'm not sure I'm following. The tax number doesn't?
The fax, the IRS fax number.
Oh, the
so
IRS
this person
fax
is trying
number.
to fax in. Right.
Oh, now that, I have not had that problem. If it's the fax number in the instructions to the 1042S for the extension, I would try doing it off hours because I'm assuming it's just because it's on overload. But if you can't get through on the fax, go ahead and mail it in. Just make sure you've got the copy of the mail receipt as proof. But if you can't get through the fax, I would just keep a record of that shows you tried and it couldn't go through, and then mail it and keep proof of mailing.
Okay, I was about to suggest that. Registered mail with a return receipt, I would say. So I think we are at the top of the hour, and this concludes today's webinar. Thank you, everyone, for attending, and we appreciate you being here. And thank you, Laurie, as always, for a fantastic presentation and for responding to the audience questions. But I do want to remind the audience that we've got a ton of questions, and we will respond to these questions that we couldn't cover today. We will keep the console open for about 5 to 10 minutes more to give you enough time to complete the evaluation. Thank you, everyone, and have a great rest of the day and stay safe.